Hello, good morning, good afternoon, and good evening, depending where you are in the world, and welcome to this webinar on financing the energy transition. I am Bérénice Lemblin, conference producer at Climate Action. Thank you for joining us. It's a pleasure to welcome so many listeners to this afternoon's webinar. We have received over 700 registrations, so it's a bit of a full house and a testament to the excellent speakers we have participating and the importance of the subject area. Please be aware that the session is being recorded and a link will be emailed to you shortly after the webinar is complete, so you will be able to listen again and share with your colleagues if you wish. Just to let you know a little bit about climate action, for the last 10 years, we have worked in a unique partnership with UN Environment to develop their official publication and events. So this is with the aim of establishing partnerships between the public and the private sectors to accelerate the green economic growth. Today's webinar takes place ahead of the second annual Sustainable Investment Forum, which is organized in official partnership with UNEP Finance Initiative during Climate Week in New York on the 19th of September. The forum will gather asset owners and managers, commercial banks, development banks, private venture capital, technology developers, mayors, and regional policymakers. Speakers currently include Andrew Steer, CEO of WRI, Betty Yee, California State Comptroller, Philippe Desfossés, CEO of the pension fund Retraite Additionnelle de la Fonction Publique, or ERAFP, Tobias Reed, the Oregon State Treasurer, and many more. So please do visit sustainableinvestmentforum.org for more information and to download the full agenda. Which brings me to today's webinar on financing the energy transition. In order to keep the average global temperature under 2 degrees, the world needs to transition to a low-carbon economy. This will involve a major and urgent shift in energy use, involving the rapid growth of renewable energy, development of new technologies such as carbon capture and storage, and innovation in energy demand and efficiency. With the International Energy Agency estimates that this transformation will cost $53 trillion by 2030, new investment in clean energy actually fell 18% worldwide in 2016, meaning that new sources of scaled finance are needed to support necessary investment and bridge the finance gap. Private and public sectors need to work together to find the solutions to redirect the existing available capital towards clean energy investment from fossil fuel infrastructure and coal-fired generation. Over the next hour, we'll explore the following questions around financing renewables. What are the barriers to increased investment in clean energy technologies? How can financial flows be best directed to meet urgent development requirements? And in what ways can policy and regulatory frameworks best support investment going forward? I feel extremely privileged to welcome 3 excellent speakers this afternoon to address this topic. Firstly, we welcome Kirsty Hamilton, former policy director at the Low Carbon Finance Group. Kirsty has spent the last 13 years leading an initiative to close the gap between the policymakers and senior finance practitioners with an investment focus on renewables and new low-carbon energy. She was policy head of the Low Carbon Finance Group, which was set up by leading debt and equity financiers in the aftermath of the financial crisis, and working in detail on UK's electricity market reform from 2010 to 2015. Kirsty will be giving us an overview from her global finance and energy policy background. We are then joined by William Cannon. William is Senior Vice President and General Manager of the Environment and Infrastructure Group at Sumitomo Corporation of Americas. He has over 20 years of experience in the development, acquisition, sale, and financing of thermal generating assets, renewable energy assets, nuclear assets, regulated utilities, water projects, port and other infrastructure assets, and he is primarily responsible for overseeing business development and asset management within his group. Bill, we have a quick overview of where global renewable installations are being built, address the issue of adapting the regulatory environment and setting up the right financial and non-monetary incentives, and finish on financiability. Finally, we are joined by Swami Venkataraman, who is a Senior Vice President in the Global Utilities and Infrastructure Finance Group at Moody's, covering utilities, merchant power, gas midstream, and renewable energy companies. He leads Moody's Global Renewable Energy Task Force. He is a member of the Moody's Global ESG team and also represents Moody's in the World Economic Forum's Future of Electricity Roundtable. Swami will explain credit risks for various type of markets stakeholders, including renewable energy projects, conventional generators, and utilities. Each of these speakers will take 5 to 10 minutes to present their views, following which we will take questions from our listeners. You can submit your questions via Twitter using hashtag Sims17 or using the question box on the GoToWebinar bar to the right of your screen. Don't be shy. We'll try and get through as many relevant questions as possible in the hour time frame. And with that, I shall hand over to our first speaker, Kirsty. Kirsty, I think you should be on now, and we can start your presentation.
Oh, thank you very much, Berenice. Can you hear me okay?
Yes, that's all perfect.
Excellent, excellent. Well, thank you very much for inviting me onto this panel on this excellent topic. I'm going to make some introductory remarks with a policy focus, and then, of course, as you've said, you've got the financing and risk experts to follow. So if we move on to the first slide, just some brief background points about this point in time. It's worth recalling that there is significant investor appetite for energy and infrastructure assets at the present time, driven by a number of market and policy imperatives. In fact, I was at the Berlin Infrastructure Forum in March this year, and a comment was made during the emerging markets session that there is currently an estimated $2.6 trillion looking for infrastructure. That's all infrastructure opportunities. And in fact, emerging markets were described there as a multi-decade opportunity, given the energy needs as well as the opportunities now emerging on renewable energy. There's also the backdrop of increased attention within financial institutions as a whole from the top on mainstreaming the response to climate, including the context of increasing pressure on fossil fuels. And we're seeing that coming through in the policy side, both on coal, not just governments, but also MDBs. The internal combustion engine has been a feature in a number of countries at the moment, like preceding or presaging the end of that in about 2040, and also in the context of pressure to divest. It's important to remember, I think, for renewable energy that we have a 10 to 15 year track record, both on the finance side and on the policy side, and that has created both a sense of an asset class emerging for renewable energy, and we'll hear much more about how that looks and how that works in practice. But I think it's also important on the policy side to reflect on the lessons that we have from that. And now, of course, we've got a system change underway, which is really the focus of the session that you've got now. And we have a broader new low carbon set of opportunities, which, by which I mean things on the storage, the demand side and flexibility side, as well as, importantly, off-grid and microgrid opportunities. That's not an area that I've got a lot of expertise in, but I can signpost some market-based sources of information about what's going on at present, including data. But the important thing is that the projects and conditions need to add up. Can we go to the next slide, please? Bernice, can you move the slides on? Please, thank you very much. This is just a reminder, because many people, including myself, are often reading things about the large volume of capital required to tackle climate change and give effect to the energy transition. And in fact, you yourself mentioned that in, I think it was an IEA estimate in the introductory remarks, Berenice. And I think it's just useful, without getting complicated, I'm not going to dwell on this slide, just to refresh our memories that there is an ecosystem of finance involved with different risk and return appetites, and this isn't a static environment. So it's by no means just about bank finance or green bonds. It's actually about, can you attract finance in from the private sector right throughout the project pipeline, because that is what delivers us outcomes on the ground, and there are many drivers for those outcomes, not only climate change. Next slide, please. Can we move the slides forward? Thank you very much. This is a busy slide, so apologies for that. I've mentioned volume of capital and the vocabulary that surrounds that, but the rubber really hits the road when it comes to conditions on the ground at the right level of granularity to attract capital and drive the development of opportunities, whether that is at very small scale or whether that's larger scale. Now, I'm slightly focusing on grid and power, and there is, of course, an important rising focus on renewable energy heat and on transport. I mean, that almost goes without saying these days. And there is an intersectoral, those sectors are increasingly linked as well. But I do really want to say two further things here, is that although policy and conditions on the ground can sound like it's always national, it is equally relevant at city level and at subnational level and possibly regional level as well if you're looking at cross-border related issues. So the extent to which the exam question is, we as policymakers at different tiers have set our objectives in the energy and development field. Now we want to secure financing for those, and now we want to attract capital. I think some of the issues that are raised in my presentation would be relevant at those different tiers. I've mentioned extensive lessons learned. We can have a discussion about those, the changing nature of the support regimes, revenue support regimes during questions, because that's certainly not an issue that's completely over. But increasingly, there is a need to evolve out of direct support in those markets where there is a sort of cost competitiveness situation with renewable energy technologies, which is what we're seeing in an increasing number of jurisdictions. But of course, that is now additionally complex because renewable energy penetration in an on-grid setting is also impacting the structure of the markets, and so that is making the equation seem to feel like often that it's got a number of spinning plates, and that makes it difficult for governments and policymakers. But as I mentioned, we do need to get down into some of the details, obviously not in a 5 to 10 minutes, but I'll just mention a sort of a number of things that are coming up, even in a sort of UK European setting. I'm sure the debates here are going to be microcosms of debates that are emerging in a number of places. So it's an exciting time as well as a complex time. But it can be a bit lumpy where you have an existing market setup that is trying to evolve as high penetration of renewables. There is a focus on balancing, there is a focus on how do we get flexibility to help us manage the profile of renewable energy. That is creating attention on how you pay for grid and distribution networks, costs as people are joining the grid in different places. Storage is a high profile issue, and of course you've got a number of issues there that are just coming onto the agenda, as well as co-location of storage with renewable energy. How do you marry up your policy and regulatory approach to one new thing with something that has a sort of perhaps a track record? So those countries that are coming to these matters new, in a way, can benefit from some of the debates that are just emerging in countries that are facing those issues now, and that's certainly the case in the UK. And there is also a sort of further tier of disruption potentially on the cards, not something we need to discuss here, but you know, what happens if there is an emerging peer-to-peer exchange of selling power. We've also got, my latest vocabulary is V2G, vehicle to grid. I mean, a big focus on that at the innovation end. So in a way, we're in a sort of collective learning redesign point. And I've put a bullet point on pipeline. I've noticed that coming up in the debate. Let's have some discussion on it if others would like to. I'm not always sure we're talking about the same thing, but I do think that policy, and very much increasingly the regulatory context, is very important for driving confidence and scale in the development of projects. So this is really about smarter, more integrated policy. in the context of innovation. So really my final, I've got a graphic that comes after this, but this is really a final sort of based on my observations at having worked at a very granular level across a whole policy process for 5 years on market design. The value that is created by having much more systematic engagement with the finance sector and investment sector, to the extent that policy wants to attract investment or solve finance issues, that will be an enormous benefit to get the right level of detail for the investors that are sought. So this is really some points. It's absolutely straightforward, testing the investability of goals and policies during their development against sectorial and overall objectives with the investment community that are assumed to be interested in coming in, those that governments or cities or others want to attract in. That direct engagement can help identify and focus on the gaps, which may be in fact a major part of the equation, or it may just be a sort of small gap where targeted public finance and other forms of support that may range from capacity building right through to no, we just need to get over the line on this newer area, this less mature technology, or we need more confidence about revenue streams in this particular area. It might be energy efficiency, which I can come back to, and that kind of engagement builds investor confidence. I mean, that's definitely my experience if it's done well and in a focused way. My last point is really that to the extent governments or city or other people who are involved in setting objectives, having more in-house capacity on finance and investment will really be a massive support, or creating the way of accessing that during the process will help, again, get to the right level of granularity as well as the overall objectives about where the ship is going. So there it is on a graphic. That is really my last slide. For clarify the assumptions, is the policy designed to attract capital? Test the assumptions with those that are hoped to be interested, and that may have a major role for public finance institutions, or it may be highly focused on private finance. And then set up a sort of systematic engagement. And for any investors listening in, I don't mean low carbon finance platforms as investment platforms. I'm using that as a sort of policy speak word, platform meaning process of systematic engagement, so that you can access feedback from broader conditions in the finance sector itself, as well as that have a bearing on delivery of policy objectives. Thank you.
Thank you very much, Kirsty, for your great presentation. I will now hand over to our second speaker, Bill Cannon. Let me just unmute you, Bill. Just one more second. Bill, I think that you will receive an audio pin that will enable you to be unmuted. It's fine. Yeah. Hello, Bill. Can you hear me?
Yes, I can hear you. Can you hear me now?
Yes, perfect. Sorry about that.
Okay, great. Okay. Well, sorry, everyone, for that. And Berenice, if I could ask you to move the slides along on behalf of me for this presentation.
Perfect.
Okay, great. All right. So again, this is Bill Cannon, and I am General Manager of the Environment and Infrastructure Business Group for Sumitomo. And I manage a portfolio of about 1.3 billion of investments in renewable energy and energy tech projects. And today I bring the perspective of a developer and owner of renewable generation. So as a bit of a background, Sumitomo is a large Japanese trading house founded well over 400 years ago. Bernice, can you click again? We have some fly-ins. While we got our start through import and export trading, we do a lot more of investments into projects and companies. We have a long commitment to the environment, which started back actually in the late 1800s with the reclamation of some copper mines. And today we've invested in nearly 300 renewable energy projects. That's wind, solar, geothermal, biomass, and some energy tech such as batteries and microgrids. As you can see from the map, we've invested in areas indicated with the red markers, and this more or less follows the pattern of global investments. Some of the common themes of where not only Sumitomo, but others have made investments are, first, having a beneficial regulatory environment, which includes allowing firms that aren't utilities to build projects and to interconnect to the transmission grid. Another theme is the financial incentives. You can have direct incentives like feed-in tariffs or tax credits, or indirect incentives like net metering or renewable portfolio standards, or government-backed auctions for power. And lastly, financeability is also an important theme for new investments. Most renewable projects have a useful life of 25 to 30 years, and the best way to make them financeable is with a long-term contract. Alternatively, you could have liquid electricity markets that have energy hedges or some other mechanism. And of course, the credit quality of the ultimate buyer of the electricity is probably the most important aspect. I'd like to focus on these three main themes to address the existing barriers and what can be done to increase investment. So the first slide here is beneficial regulatory environment. And electricity is highly regulated, as I think we all know. And quite simply, there is less renewable energy being built in places that still have the old, fully integrated utility business model. So the first step would be to modernize the utility regulations. And for this, there really is no one correct answer, but you can look through different countries and see the best ways to do this. Next would to ensure that the grid is able to sustain renewable energy. And Kirsty touched on this a little bit. But some of this is done by strengthening the transmission grid or potentially interconnecting various grids within a country. A good example is the nearly completed transmission line in Chile, which connects the far north Atacama Desert region with the central grid of where Santiago and most of the energy demand is. This new line helps to unlock new investments in the Atacama region, which was previously constrained due to limited demand. Regulators can also encourage batteries through either market design or storage requirements for utilities. Sumitomo developed and now owns the Wiley battery in the US that takes advantage of some of the market designs to help stabilize the grid. And this then leads to better integration of the renewable energy in that market. And that was on the regulatory side. On the corporate side, customers can also encourage new generation through an integrated package that includes battery technology and perhaps solar. Here, the idea is that the customer will size a solar project to its daily needs and store the excess into the battery during the day and then discharge it at night. Sumitomo is at the forefront of this type of integration, working with Nissan to recycle some of the batteries from electric vehicles to be able to create microgrids to store the energy to be used at nighttime. This type of system is a bit more expensive and more on the early adopter stage at this point. However, this is something that commercial or industrial companies can pursue on their own without the need for any change to the existing current electricity regulations. A final step would be this wholesale change of the utility business model and the introduction of virtual power plants. Here, the idea is that a customer would have an integrated battery and renewable project at their site, but turn over control to the utility to allow it to integrate it into their system. The same can go for recharging of electric vehicles as well. And the utility will pull power from these sources during peak demand times and then send power back out when there's less demand of electricity. However, this requires a fundamental change to the rate structure of a utility, away from one based on selling electrons to another structure, such as monthly fees or something else like that. There's a local utility in Vermont here in the US that is testing this concept, and it should be interesting to see how this plays out. That sort of focuses on the demand side of the equation, which I think we all here on the phone have some influence on. On the supply side, the barriers that I see are trade policy. This is mostly import tariffs or local content requirements, tax policies, and restrictions on the inflows and outflows of capital. While these are very important, these are a little bit out of my scope as a developer and owner of assets. On the next slide, I want to discuss some financial incentives, which are probably the easiest and the fastest way for regulators to promote new construction of renewable generation. Feed-in tariffs work extremely well and are typically the first way most countries incentivize renewable generation. For example, in Japan, where Sumitomo is quite active, the government introduced a feed-in tariff in 2012. And since then, over 40 gigawatts of solar have been built and roughly 100 gigawatts have been approved. Another example is in Europe, where Sumitomo is also heavily invested. The offshore wind feed-in tariffs were highly effective and are now slowly evolving into more of a competitive bid structure. But with the feed-in tariffs, over 18 gigawatts have been installed and another 20 gigawatts of new projects have been tendered or otherwise committed. Tax incentives also work, but less well, and this is despite the robust installations in the US. Tax incentives limit the pool of capitals that can invest in projects. By definition, you have to be a taxpayer, though there are ways to sort of structure around this. The need of feed-in tariffs and other monetary incentives is diminishing as capital costs for wind and solar come down. For example, there was a recent tender for offshore wind that was awarded in Germany at a €0 subsidy. On the next slide, I'd like to discuss non-monetary incentives that can still create a robust environment. Government auctions for new generation, such as what's happening in Mexico, where the government is actively encouraging RFPs for new solar and wind projects, and so far over 5 gigawatts have been awarded. Other markets such as Chile and the Middle East have opened up their markets to via long-term contracts and show that subsidies may not be needed. But of course, Chile and Middle East both have amazing solar resources, so maybe they're not the best example out there. Net metering is also very effective at incentivizing solar in homes and commercial buildings. Net metering is basically allowing a user to sell electricity back to the utility at retail rates as opposed to wholesale, sort of like spinning the meter backwards. There is an economic downside that Kirsty touched on this a little bit as it creates stranded assets, such as the distribution and transmission wires, and the remaining customers on the grid have to pay for these costs. Renewable portfolio standards also can be an effective way of creating new demand for projects. Longer term, more challenging efforts by governments and regulators can include the elimination of subsidies for coal mining or natural gas production, or for the generation facilities that burn these fuels. They could also consider the creation of a carbon tax. And then on the supply side, governments can help through funding of new technologies, such as carbon capture and sequestration, or non-battery storage ideas like solar thermal using molten salt or flywheel technology. On the next slide, I'd like to discuss the financeability. So first, what creates a financeable project? Well, it really depends on the capital markets. So where capital is robust, investors and lenders are willing to take long-term views, and long-term contracts are the most effective way in reducing the financial cost for a project, and therefore reducing the levelized cost of electricity and making it more competitive and cheaper for the end users. To encourage investments in countries where capital and credit are more limited, government agencies or MLAs can directly provide funding for projects, or they can provide insurance coverage for payment risks. Or as demonstrated in Argentina, countries can also establish trust funds to help secure future payments. Corporations can also help to make projects more financeable. As an example, back in 2014, Sumitomo was fortunate enough to enter into a great partnership with Mars Inc. You know them as the companies that make M&Ms and Snickers. They have a very robust clean energy program that led them to seek out a solution to power their entire US operations through sustainable energy. We helped them achieve this goal via the construction and operations of a 200-megawatt wind farm in Texas. And some of the lessons that we learned on that project is first, well-intentioned CSR policies need to be championed throughout a firm. And very understandably, many companies take a short-term view on procurement, and most don't think about electricity as a commodity to be purchased. And if you add that to the focus on additionality, you can create a very challenging environment for renewable projects. However, the key takeaway here is that corporate buyers of electricity may be the only way to build a renewable project where regulatory hurdles are high, where the credit quality of the local utility is quite challenging. So on the next slide, I'd like to summarize where I believe there's a significant pent-up demand for investments in clean tech and energy investments. If you just look at the current return requirements here in the US at single digits, mid-single digits, this sort of indicates to me that there's a lot of equity chasing too few opportunities. To unlock this demand, regulators can create an environment where renewable energy can thrive by creating fair and open markets, enabling long-term contracts through utility-backed energy auctions, or direct subsidies like feed-in tariffs, though they don't necessarily need to be at above market levels. Corporations can promote new investments in renewable energy by rethinking their procurement strategies for energy. Going green needs to come out of the CSR department and into the CFO and Treasury group. Corporations can also work with developers on energy solutions such as solar and battery projects, or providing long-term contracts for supply. So this wraps up my presentation for today. Thank you.
Thank you very much, Bill, for your great presentation. I will now hand over to our last speaker, Swami. Swami, I believe it's the same kind of issue as with Bill. I think you have to enter a PIN that was sent to you, and then I can unmute you. Should be a few more seconds. Swami, I hope you have received the PIN. Okay, so it seems that we are having a bit of trouble getting Swami. So in the meantime, we have already received a few questions from the audience, so maybe I can ask one of them to you, Kirsty, and you, Bill. There is actually a very interesting question here that asks about I'm going to unmute you both so you can answer. So how can we bring sustainable solution to the transport system around the world, which is still relying a lot on fossil fuel? So that's a question from our audience. Maybe, Kirsty, if you wanted to start answering.
Thank you very much. So I think with the transport sector, there is a live debate at present about the shift to the pathway to decarbonise the transport sector. That includes a strong focus on the shift to the electrification of vehicles, with a side debate about the role of cars, the model of vehicle ownership and use, and also the next phase of vehicle technology, by which I mean the move to autonomous vehicles. But there's a very strong focus on electrification and what that means in practice, and this is where it intersects with the power system, and also some of the debates about storage and what's driving battery technology and battery technology cost reductions. There is also a debate, it's less mature, about is electrification the way to go? Is there not still residual interest in hydrogen as a more another option? I would say that debate is much smaller in the frame, but electrification of vehicles, but it's not only about vehicles. So the question is, what will drive that? And I think that is a core issue that intersects national government with city planning in terms of charging, post-charging infrastructure, in terms of if you're looking at investment opportunities. But I think there does need to be a sort of strong helm held by people who are designing transport systems, as well as enabling innovation, both in terms of how charging models will evolve. This is charging stations, but also how battery systems can intersect with distribution network, households, and participate in the balancing and management of the power system as the system change embedded in the transition evolves. I mean, that's not a very easy prescription list of we need to do this, this, and this, but I think there needs to be, you know, this is one area where you do need a pathway set out that tackles the various aspects of the transport sector.
Bill, did you have anything to add?
Yeah, I mean, I would just add that at least from a perspective of someone living in the U.S., I think the easiest way to impact the transport sector is through government intervention, meaning, you know, subsidies for people to buy new electric vehicle cars, or somehow increasing the standards for fuel efficiency on some of the long-haul truck systems, so that you incentivize people, either you directly incentivize them or indirectly, you know, hit their purses, so to speak, and that way you can help push along the conversion from gas to electricity.
Thank you very much. Good news, Swami is online now, so he's going to be able to do his presentation now. Swami, can you hear me?
Yes, I can. Can you all hear me?
Yes, that sounds perfect. Sorry about that. We can now
all
go
right,
on
sorry,
to
everybody.
presentation.
And maybe what I'll do is I'll add a point to this question on transportation before I start off on my slides. Absolutely. I think the one thing I want to point out is why renewable energy is so important is precisely for the reason that when you talk about broader decarbonization, the answer usually tends to be electrify whatever system you're talking about. So in this case, it's electrification of transportation. It could be electric cars. It could be public transport, which uses electricity as well, trains. There is a component of hydrogen or other fuels, but I think the momentum is clearly on electrification of transportation. There are some parts of the world that are considering electrification of home heating as well in order to avoid the use of natural gas in homes. So it kind of brings the electricity sector front and center, and it makes renewables even more important because you first electrify other sectors and then you use renewables to supply electricity. So it kind of makes that whole discussion even more important from my perspective. But can you move forward to my first slide? Yeah, forward. I want to begin by basically saying, you know, the good thing is from what we've seen in all the major markets in the world has been a dramatic reduction in the cost of renewables over the last several years. I'm sure all of you are familiar but the charts that you see on the slide here show just how much prices have declined just over the last 5 or 6 years. And you're seeing prices that are a quarter or sometimes even lower than that of what they used to be just several years ago. And this trend actually does not show signs of ending at this point. We still see continued decline in costs. Solar panels, for example, have declined 20% or more just since the fourth quarter of 2016. So there's this kind of declines that continue. You've seen improving efficiencies and higher capacity factors, and these have happened across the world, across all the major markets that you see. And in the two relatively newer technologies in the renewable sector, offshore wind and energy storage batteries, you see the same patterns, that they seem to be following the same pattern of very sharp and sustained declines in costs. So I must say that while we talk about the availability of capital and the trend of declining costs is perhaps the most important driver that creates demand for renewables and that makes it easier to finance renewables. And so in that context, both Kirsty and Bill have talked about the importance of various kinds of incentives. But I want to also sort of emphasize or point out that we are seeing a trend where in different markets, there is actually a movement away from subsidies, and we're calling it, say, renewables beyond subsidies. There are many markets in the world today where renewables are already competitive with fossil fuels. And so some markets such as, India, China, even parts of Europe are transitioning to auctions. Latin America, in the US, you don't have auctions specifically, but you have competitive bids that every utility solicits. So in effect, it's an auction, if not a nationwide auction, it's certainly an auction at the utility level as well. In fact, in parts of the US in particular, wind energy today is so inexpensive that the all-in cost of wind, including capital costs, is lower than just the fuel and operating costs of coal plants, ignored the capital costs of coal plants. And so you've come to a situation where you've seen a trend of utilities in the middle of the country, the Great Plains parts of the US, where are simply shutting down existing coal plants and replacing them with new wind plants in a sort of win-win-win. You get a cleaner system, you can reduce rates to customers, and utilities are able to invest in new assets, and it's profitable for them as well. So I think it's important to sort of keep that in mind, that you are seeing a situation today where investments in renewables is being driven by economics, not necessarily by mandate or fiat on the parts of governments. You do have the Paris agreements that most countries have committed to, targets, and those targets are laying the foundation for more demand, but those targets are easier to meet now because renewables are so cheap. Next slide, please. So in the context of all these discussions, Bernice, can you move to the next slide? Yeah. Everyone's talked about, what would need it. What I want to spend some time is really talking about what are the risks that may make a project perhaps potentially unfinanceable, or maybe it might reduce the pool of lenders from a credit perspective available to lend to these projects. Now, I want to emphasize that globally, wind and solar today are very well understood. Lenders are comfortable with the technology. Lenders are comfortable with the operating profile. The way to finance these are well established. You have the banking systems in most countries willing to step up to lend. So the idea here is to point out where risks exist, rather than to say that these risks are, kind of preventing development, but just where do they exist to the extent that they do. So as people get more comfortable with renewables, we've seen changes to the contract structures. Historically, it's a one fixed price for 20 or 25 years. And that is essentially, it could be a feed-in tariff, it could be a PPA, and it gave projects a lot of revenue certainty. Now you're seeing uncertainties being introduced in various forms. China is talking about green certificates. This is really, really new. It only started in July last month, so it's too early to really talk about how much of a risk it's adding, but to these green certificates are going to be a replacement for the subsidy that was provided by the Chinese central government. And to the extent those certificates result in uncertain pricing, it could add a little more risk to these projects. In the UK, sometimes you've seen the price for renewables being the wholesale power market price, which fluctuates, and an adder on top of that. But the fluctuation in wholesale prices could obviously mean fluctuating revenues for renewable projects as well. In India, you've seen cases where you have a 15 or 20-year PPA, but the tariff can change at the end of year 10. And so, so there are certain types of risks, or you might see shorter tenors in the PPAs. In the U.S. and Texas, we've seen a number of wind projects develop based on just a 5 to 7 year hedge that's available in the power markets without any PPA at all. Or in the worst case, you might see whole contracts being renegotiated or repudiated, like happened in Spain with solar about the 2008, 2009 sort of time period. So you have these kinds of risks, and I'll go through each one of them just to indicate what the impact could be. And then I'm happy to take detailed questions on any of them. The other big risk that Bill mentioned as well was counterparty risk. Who is the buyer of the electricity? If they are of low credit quality, many state utilities in India are known to be of low credit quality, at least from an international lender's perspective. And that leads to a lot of uncertainty. In fact, that has long been cited as a bottleneck for growth, faster growth of renewables in India. You could have in the US, you have a new type of animal called a community choice aggregators. And these are just cities getting together and deciding to buy renewables to serve their own residents. These entities have not been publicly rated at this point. Their credit quality is sort of unknown. And one could say with a fair degree of confidence that they're probably likely to be, riskier than, the well-established large utilities that you see in the country. Similarly, you may have good credit, but you may have payment delays. And subsidy payments in China, for example, have known to be substantially delayed for many, many projects. And that is one of the reasons why they introduced green certificates in China as a way to sort of eliminate that kind of delay. So that could be an issue as well. And then, of course, if you have just a merchant project with no contract, it's really, it's risky because you're just relying on the wholesale markets for your revenues. The third kind of risk could be risks around technology cost assumptions. What has happened, particularly in the case of solar, is that people see how fast the price of solar panels have been declining. And so when they bid into these auctions, they know that the projects are probably going to be constructed a year or two down the road. And so they bake in a decline in panel cost. So if today a panel costs, let's say, 50 cents, it's probably 40 cents now, but let's say 50 cents. The project might assume that by the time they actually get around to buying panels, they may be able to buy it at 40 cents. But what happens, let's say, if instead of 40, they're faced with 60 cents? It's almost a 20-30% difference in project cost. That's enough to sink a project, or, it would need a lot more debt to construct a project. So those kinds of assumptions could potentially be risky. And, lenders are going to look into that very closely. And then a related problem is that solar auctions have gotten so competitive and the prices have gotten so low that there really isn't any cushion in terms of the ability to, if there's a construction delay. What happens if there's a construction delay or a cost overrun for some reason? There's really no cushion in these projects. They are priced to perfection in many ways. And so that could be another source of risk from a lender perspective as well. And then you could have operating risks. You could have a case where the utility might curtail renewables and not take them. It could be for economic reasons, if renewables are more expensive, or it could be for stability reasons, where the grid is not stable and you need to sort of not take some renewable energy in certain hours. China has seen a lot of that. And the government has stepped up by saying you have to have a minimum utilization hours for renewables. And you've seen that happening from time to time in the US as well, in Texas, for example, and I think in California and the Midwest. And then finally, in terms of financial risks, to the extent you are developing projects in the developing world, sometimes the projects may use dollar-based international funding, but the revenues of the project might often be based in the local currency. And when you do that, you incur foreign currency risks that need to be managed, with a certain degree of care, and you may not be able to hedge it for a long period of time. Bernice, next slide. So these are, this slide I talked about thoughts around just renewable projects themselves. But I think it's important to consider that renewables are not developed in a vacuum. They are part of the broader electricity grid. And whether it's just the electricity grid or whether you're thinking about electrification of transportation and so on, it's important to kind of keep the broader context in mind. Who are the other players in electricity? What are they doing? What does that mean to the stability of the system? And one could not, I think Kirsty referred to that in her comments when she talked about how the system is able to accommodate a growing share of renewables. So I want to spend a few minutes briefly addressing the two other major types of players. You could have independent power producers, and I think I would point to Sumitomo itself as one such entity who develops projects around the world. Now, Sumitomo is mainly focusing on renewables, but there are others who focus on traditional, conventional generation. So if you're a power producer, if you're a renewable developer, say Sumitomo, you're in a great position. You got strong positive growth momentum, a lot of growing demand, and so on. But it's more important to consider what happens to conventional generators. You're seeing depressed, sometimes even dysfunctional electricity markets for conventional generators in many countries. The first thing you see is very low power prices. You see that in US, you see that in parts of Europe when there's lots of renewables coming in. You see that in Latin America as well. In Chile, for example, there have been auctions where power prices have been coming down very significantly. You see loss of market share for conventional generation because coal plants are being dispatched much less, and being replaced by renewables or maybe sometimes by natural gas as well. As a result of these low prices and loss of market share, you're effectively coming to a situation where you cannot recover costs, and plants are being shut down. There could be coal or nuclear in the US, there's gas in Europe. In fact, things can sometimes get so bad, the market price for electricity becomes negative in the US in many hours of the year. I have seen plenty of times when the price of electricity was a negative $5. And what that means is that an electricity producer pays the buyer money in order to take electricity from its plants. And there are lots of reasons to go, don't have to go into why, but clearly all of these means that there's a lot of debate about market structures, both in the US and Europe. What needs to be done to ensure the integrity of the grid and the power markets? Because as you go through a transition, you might envisage a future when there's not a single coal plant operating, and maybe even gas plants, the older gas plants are shutting down and so on. But to get there from here, there is a long transition, and you need to ensure the integrity of the markets and power supply during that time frame. Next slide, please, Bernice. The last is, in terms of utilities and what happens with them. The previous slide, and not this one. If you stay with electric utilities, yep. So here, this is more complicated. These are the entities that own the grid, effectively, the wires. They may also own generation, but they own the wires. And there are a number of things that you see. There are a lot of positives in the existing business model, the way things stand today. They can invest in renewables. They can invest in the grid, in transmission that Bill pointed out. They could get to invest potentially in storage, in smart meters. There are lots of opportunities for these companies. But there could be risks in existing models. You could have stranded assets. They could own a lot of coal plants that suddenly are worthless. And, potentially there's a risk that they may not be able to recover their investments. There could be a loss of the monopoly customer relationship. as you see distributed generation growing, and smart grids and so on, other things coming up, microgrids and so on, the relationship with the customer could be lost. In the city of Las Vegas, for example, we have a lot of casinos, large casinos, who are paying money up front to the utility to just get out of the system and buy their own electricity. And some big casinos have done that in the last year or two. But there are also new opportunities in terms of energy services, in terms of building new customer relationships, and it depends really on how the utilities manage to navigate this whole sort of this trend and how they position themselves to take advantage of opportunities. Next slide. I want to make a last point on storage. I think this is the key technology to enable the growth of renewables. Otherwise, as renewables keep growing and increasing their penetration, you go from 10% to 20% or so of the entire grid. Very few parts of the world, maybe Germany or some other parts, have a lot of renewables, that level of renewables. But when you get to that level of renewables, it creates other problems. And I think storage is very well understood to be the major issue, major technology that needs to grow. I can talk more about how to finance storage. I don't have time, but I will talk more if there are questions on that. But essentially, the good news is that, as you can see in the bottom right, there's a dramatic decline in prices. The blue line that you see in storage pricing in just over the last 4 or 5 years, it's kind of very similar to what happened to solar panels. And people are talking about another, you see prices around the 200 to 300 range. But people are talking about, companies are talking about prices going down to the $100 per kilowatt hour range by 2020 or so. So, there is good news here, but the growth of this sector is going to be certainly very critical. It's becoming more viable already to use in a variety of different applications. But I can talk more about financing storage and risks there as part of the Q&A. So, Bernice, I will conclude my comments there and happy to take any questions.
Thank you very much, Swami. It was really interesting. We have received a lot of questions from the audience. It seems that it's really popular topic. So maybe we could start with a question from William, who is asking if about hydrogen and how it was mentioned as having small interest. So he's asking what is keeping it from driving more investment. So let me unmute everyone, and maybe Bill, if you wanted to start answering that question.
Yeah, hi. So from a perspective of a developer or an owner of these sorts of assets, hydrogen is still a little bit more of a new technology. I think you are seeing some people invest into it, but I don't know if it's been well proven out that it is a winning technology yet. I think the jury is still out on that one item. But assuming that it does work out, I do believe that you will see continued investment in that technology.
I see. Karastira, Swami, did you have anything to add?
The only quick thing I would add is I agree about the unproven technology part, but the question is, there is no getting away from electricity. You will need to use electricity to produce hydrogen in any case. The question is just where the electricity is used. You might conceive of hydrogen producers in some central refinery type place who are producing hydrogen and then distributing it to gas stations across the country, or you could imagine it as people with electric cars just using electricity in their homes. So the connection to renewable energy and electricity cannot be avoided even if the transition happens to hydrogen.
That's great. Karastira, do you want to add anything, or should we go on to the next question? Of course. So there is a question about crowd investing and how this could fit into developing opportunities for renewables. So that was a question asked on Twitter. Did anyone wanted to address this question of crowd investing?
Let me take a stab at it. This is Swami here. I think cloud investing, I wouldn't see it purely in the context of renewables alone. It is true that increasingly utilities are seeing opportunities in cloud investing. Let me give you a concrete example. There are lots of sensors being put everywhere in the grid now, and that includes not just at the meter at the home, but at the local transformer, at the substations, at a variety of different places along the grid. And there's enormous amounts of hourly data coming in. And so utilities have talked about how this data is so useful so that outages are known, at least today, they're already known instantaneously. But in future, they're talking about using this big data to even do predictive outage maintenance. So even before an outage happens, they're able to predict using data analysis where it is more likely to happen and when, and they are able to actually prevent it by undertaking maintenance, in advance. This sort of data with consumer level data, like people like Google have invested in Nest, the smart meter, the smart thermostat, company, and you collect a lot of consumer data. That's going to be important to provide energy services to companies where companies are usually companies, but maybe even to a large group of residential customers, where you can optimize your own supply by exactly knowing the consumption patterns on an hourly basis across customers. So I would not think of cloud necessarily as linked only to renewables. I would think of it as enabling new types of services in the context of the modern grid that uses a lot of renewable energy.
Great, thank you, Swami. Kirsty or Bill, did you have anything to add?
That's right.
All right. There's another question. I think, Bill, maybe you could answer that one about if you had any experience in financing energy efficiency technologies, and how would that work exactly?
Yeah, energy efficiency is a great concept, and as the question that comes across sort of adequately addresses is, how do you get it financed? And that is very challenging, to be honest. A firm like mine would not be doing something like that. What I have seen directly is government agencies or utilities through their rate-making system have incentivized homeowners or industrial users or commercial users to do some of the energy efficiencies. But I will say that it is a challenging aspect to first quantify and then monetize and then finance, right? And I think Swami can probably address this as well, but it's extremely challenging to get financing off of the concept of saving money.
Well, I completely agree with Bill. I think it's hard to measure what the baseline is in many cases as well, in order to compare what the savings are from energy efficiency. The best way to do it is, as you were saying, through utilities. In fact, it's been happening quite a lot. The U.S. Consumption is hardly growing and even declining, in many cases. And the electricity consumption, I don't believe has even still today reached the peak that it had before the 2008 financial crisis. So for over 10 years, we've had flat to declining load. We had a bounce back in 2010 when the crisis ended, but overall, it's still been a downward trend. And most national plans, if you look at the Paris national plans, one of the most important components of it tends to be energy efficiency and reducing the energy intensity of GDP over time. And so I think it will get implemented. It may not get implemented, financed separately as a project, but it usually tends to get done, through the utilities or simply incentives. People are offered incentives to buy a more efficient refrigerator or use LED bulbs at home and things like that.
I might just step in here. It's Kirsty. I've noticed that there's far more attention on both a wider spectrum. One of the challenges is what is energy efficiency, and it can be used from some of these demand side responses that are now able, for example, to bid into capacity markets in order to help manage system variability at the electricity system level. And so would we describe those as energy efficiency, because some of the incentives there will require a review of how those countries with capacity markets work. And there's, you know, at that level, it's probably going to be quite system specific. But I would just also highlight, in case it's useful for anyone, we've seen in European debate the emergence of a group called the Energy Efficiency and Financial Institutions Group, and they've recently produced an underwriting toolkit to help financial institutions do value and risk appraisal for energy efficiency projects, to see how they can bring forward more standardization and greater comfort with that. And I think that's available on the UNEP, UN Environment website as well, or maybe it's the UNEP FI website. But that might be something that people who are particularly interested in that area, which is very important, want to have a look at, to look at how the lineup of factors that financial institutions will have to get comfortable with, depending, of course, on what you're talking about.
Thank you very much, Kirsty. I think there's one last question. We're drawing to the end of our time here, but one more question for Kirsty, I guess, first. Someone is asking, how can policy encourage investment when long-term purchase agreements are not forthcoming? So do you want to say something about this?
Well, I mean, I think that is, it's another, I mean, my presentation probably sounded quite general and absent a whole series of prescriptions, but I certainly think that that is one area that is under hot debate in countries that are coming out of, for example, support mechanisms for renewable energy, revenue support mechanisms, whether they're feed-in tariffs or even auctions. Will you get bank financing against merchant risk? So that was raised by Swami as well. Will you be able to finance a project where you're facing fluctuating power? And also, will corporate power purchase agreements, there is a considerable amount of interest in whether, if utilities are not offering long-term power purchase agreements, will the corporate sector, as it evolves its strategy, and again, this was mentioned, I think, by Bill, will they be a provider of those long-term power purchase agreements that can act as a kind of bridge as this market evolves, as the system evolves for around renewables and the management of variability? So I think there's, you know, short of government stepping in or regulation obligating long-term power purchase agreements, I think those two areas, how can financial institutions get comfortable with merchant risk in a power market, or can corporates step in? That's certainly the debate you're seeing in a number of places in Europe.
Thank you very much, Kirsty. Did Bill or Swami add anything to this? And then we're going to end on that question otherwise.
The only thing I would say is it kind of, the answer depends maybe on which country or which part of the world you're talking about. Most major regions of the world do have the ability to provide PPAs, and it's not like in the U.S. we have seen both corporate PPAs. In fact, in the year 2015, more than half the renewable energy in the U.S. was corporate PPAs. That they bought more than utilities did. And you also have a history of merchant financing in Texas, and particularly in the state of Texas, for example, for wind. But that really depends on having a very liquid forward electricity market, wholesale electricity market, which perhaps is not present in most other countries, and the presence of financial institutions willing and able to provide hedges for, say, 5 years or 7 years, which again, the US has large financial institutions willing to do that. So the answer might be sort of country or region specific to that.
Thank you. Thank you very much. So we're now coming to the end of our webinar. Thank you very much, Bill, Swami and Kirsty, for taking part in this very interesting discussion and answering our audience's questions.